Hey everybody, welcome to the Dan Habib Show. I'm your host, Dan Habib. Today we're going to be talking about a surprise oil production cut from OPEC and how that's going to negatively impact inflation, as well as some jobs data from ADP and some home price appreciation reports. So stay tuned. But a couple quick reminders. If you want to find out the best insights every single day and you're in the mortgage and real estate space, come check us out at mbshighway.com. You can sign up for a free 2-week trial. And also, if you're an investor or want to learn more about cryptocurrencies and want the best edge from technical analysis to on-chain analysis, breaking down coins and projects, whether you should go long or short and how to do that, check us out at cryptocharts.com. If you use code Habib, you will get 40% off if you sign up today. Also, please support this channel. Would really appreciate it if you liked and subscribed below. But let's get right into some of the news and the data that we got today because, boy, it was surprising. You know, the economy has certainly been beaten up a little bit as of late. And the biggest problem around the globe is inflation. And we see central banks out there trying to quell this inflation by hiking their version of their central bank's rate. Here it's the Fed funds rate. Well, OPEC came out after their meeting they had today and decided that they want to cut production of oil by 2 million barrels per day. Just to give you an idea of the scope of that, the average consumption across the globe per day is about 100 million barrels. So this is about 2% of a production cut. And what do you think that's going to do to oil prices? Of course, it's going to pressure them higher. And you couple that with the fact that the U.S. has been tapping into the Strategic Petroleum Reserve to the tune of about 1 million barrels a day to provide some additional oil and to help with prices, which goes away in November. Boy, you could have a problem where oil prices, in my opinion, are going to scare triple digits again. I think they will get above $100 a barrel. And what is that going to do for inflation, right? Obviously, headline inflation numbers are going to go higher because oil is a big component, but even when you look at the core readings, which strips out food and energy, oil is still in there because it affects so many things indirectly, causes product prices and all kinds of deliveries and shipments to cost more. So this is really like OPEC kicking the economy while it's down. And certainly, I think, was not a great move at the time to do here. And it's going to pressure inflation higher, and I think make it more difficult for the Fed to get inflation under control. We also got some jobs data from ADP. Now, there's two main jobs reports that come out every single month. Usually the first Wednesday of the month is the ADP report, and the first Friday is the BLS, or Bureau of Labor Statistics, jobs report. Now, the big one we're going to be getting this Friday, and we'll cover that for you guys. But this morning we got ADP, and it showed 208,000 job creations in the month of September. Now, there's always expectations for these reports. Well, the expectation was 200,000. So just a hair above or better than the market expectance. But if you take a look at the revisions to the previous month for August, well, that was revised higher by 53,000. So all in all, it was a pretty good report. Now, ADP has recently redone their algorithms and the way that they get this data, their methodology. And they also now have some components on how much earnings have gone up. Well, across the U.S., their sample size, by the way, is very large, about 25 million payrolls that they're looking at. Well, this is showing that incomes are up 7.8% year over year, which is pretty significant, although still beneath the pace of inflation. And that's for job stayers, meaning if you're in the same job, your income has gone up 7.8%. But how about for those people that have changed jobs to look for higher pay? Well, they're up 15.2%. So, seeing incomes rise significantly, which has certainly helped to combat the negative impacts of inflation, but still trending below what inflation is. And this is not necessarily going to be a good tell of what we're going to see on Friday with the BLS jobs report because it's a new methodology. We don't know how well these are going to correlate. For instance, if you look at the last report, ADP showed for August 185,000 job creations. And the BLS big jobs report that we're going to get, that one showed 315,000. So not exactly on par with each other. So it's tough to say whether or not based on this report, we're going to see a strong jobs report on Friday. But rest assured, that's the big one that everybody's going to be looking at. Right now, the market is expecting 250,000 job creations. So if you get a number above that, you'll probably see the markets, mainly the equity and risk on markets, like that. But the other big component is the unemployment rate. Right now, the unemployment rate's at 3.7%. It's anticipated it's going to remain there, but this is a big one because the Fed has been able to hike rates to quell inflation under the guise or the cover that the job market is still strong and unemployment is still very low. So if this starts going a little bit higher, boy, the Fed could really be in a tough situation where maybe they'll have to start slowing down the paces of their hiking or maybe even change direction if things get too crazy. So something to keep an eye on. And remember, Friday, the big BLS jobs report. But let's go ahead and change now to housing. Well, we know housing, it's been a tough go, right? We have interest rates now just under 7% in a lot of cases. And it's not easy to qualify for a home. Homes are more expensive, right? We've seen some massive appreciation over the last few years. Not a lot of inventory still. So the housing market has been seeing a slowdown, especially on activity. We got application data this morning showing refinances down 86%, purchases down 36%. Now, in that application data, you do have to remember that this does take into account last week where a lot of the areas around the U.S. were impacted by Hurricane Ian, and this could be impacting it. But we also saw rates increase significantly last week, and since then they have come down a little bit. But let's talk about appreciation. So if you look last month, CoreLogic released their home price index report today for last month, and it showed that home prices decreased by 0.7%. On a year-over-year basis, they are still higher by 13.8%, but that's still been coming down because, not too long ago, several months ago, they were showing 20% year-over-year appreciation. So still positive, still very strong. I anticipate that to continue to come down, but are home prices going to continue to see negative monthly readings? I think it's going to vacillate. I think we're going to see home prices go up and down a little bit on a month-to-month basis, but here's the big thing. CoreLogic released their forecasts. They expect for the next report, home prices to remain flat, and they anticipate for the next 12 months, appreciation of 3.2%. That's a big distinction, right? There's going to be some volatility, but when people are analyzing, should I buy a home or not, their time horizon is not normally 3 months or 4 months or 5 months. It's normally what? 5 years, 10 years, even longer potentially, right? So I still think now is a good time to buy a home. Right now, you are not seeing, all the competition out there that you saw where there was 30 offers on a home. You can certainly have more of a buyer's market right now. If you get in now when rates are a little bit higher, I think you'll have an opportunity over the next year to refinance that into a significantly lower rate. But hey, listen, 3% appreciation over the next 12 months, is that significant? Well, if you buy a $400,000 home and you put 10% down, your investment is $40,000, right? You have to pay monthly to live anywhere, whether you're buying or renting. But if you see 3% appreciation on a $400,000 home, that's $12,000 in appreciation. You divide that into your investment of $40,000, well, you'd have a return on investment of 30%, thanks to the power of leverage. So still quite significant and powerful. But remember, there's going to be vacillations, and real estate's very localized, so some markets may do better than others. But overall, I'm in agreement with CoreLogic that I think over the next 12 months, although it will be a little rocky, you will see some very modest levels of appreciation, not depreciation. Guys, thanks for tuning in. Make sure to come back on Friday. We're going to be breaking down that all-important jobs report, which can really impact the market. But please like and subscribe and support the channel. And until next time, have a good one.